Greetings, class. Today's lecture explores one of the most dramatic and revealing phenomena in modern finance, rogue trading, always a class favorite. This is where a single trader, acting without proper oversight, takes positions so large and so risky they can bring entire institutions to their knees. At first glance, these stories sound like Hollywood thrillers. One trader outsmarting, outmaneuvering, and ultimately outwitting even their own bank. That is, until the losses are too vast to hide. Yet behind every headline grabbing case, we find the same core issues: flawed internal controls, misplaced trust, and systematic incentives that reward high risk but punish transparency. To understand how this happens, we'll begin by looking at how trading operations are supposed to work, the division of labor between the front, middle, and back offices, and then trace how traders like Nick Leeson and Jerome Carviel bypass those safeguards to inflict billions in damage on their respective firms. Finally, we'll examine the risk management and organizational failures that make rogue trading not just possible, but almost inevitable under certain institutional and cultural conditions. So, let's get started with the basics. In any large investment bank or trading organization, the work is divided into three broad categories. First, the front office. This is the money making side. The traders, salespeople, and deal originators. Their job is to take positions, structure products, and generate profits. Think of them as the revenue engine. And, as you probably guessed, rogue trading always starts in the front office. Then there's the middle office. These are the risk managers and controllers who monitor exposures, check compliance with trading limits, and value positions independently. They're the internal referees, if you will. Then there's the back office, the administrative backbone that settles trades, reconciles accounts, and ensures that what the front office says happened actually did happen. They confirm trades, process payments, and record the books. In theory, this segregation of duties creates checks and balances. Traders take risks, risk managers set the policies and monitor it, and operations verifies it. But in practice, these barriers can erode, especially when traders become star earners, management becomes complacent, systems are outdated or siloed, when this segregation of duties is compromised, or when front office traders have special knowledge of back or middle office systems or access to them. So, with that said, let's begin our story with Nick Leeson, whose actions brought down the British financial House of Barings, a bank founded in 1762 that had survived the Napoleonic Wars, two world wars, and a depression, but couldn't withstand the losses Leeson's rogue trading piled up in the early 1990s. In the early 1990s, Barings sent Leeson, an expert in the growing derivatives trade, to Singapore to run its operations on the Singapore International Monetary Exchange, or SIMEX. Crucially for our story, Leeson was placed in charge of both the front office trading desk and the back office settlements confirmation function, a fatal combination and corporate control failure of colossal proportions. In other words, Leeson was marking his own homework. When trading losses occurred, he could and did hide them in an obscure error account, which he labeled account 8888888. Instead, he simply reported his profits, which were considerable. In 1993 and 1994, for example, he recorded trading profits of 9 and 28 million pounds respectively. Of course, his hidden losses far exceeded these, recording 21 million and 185 million in trading losses in 1993 and 1994 respectively. To understand what was going on, let's take a look at Leeson's trades. As for how Leeson was losing money, Leeson was accumulating thousands of futures contracts on Japan's Nikkei index, essentially a bet that Japan's stock market would go up. The Nikkei had cratered a couple years prior, following the bursting of its stock and real estate bubbles, which had built up in the 1980s. And Leeson likely believed it was time for Japan to get back on its prior economic tear. A major contrarian bet, as Japan was on the path to its lost decade of economic growth. But without the benefit of hindsight, however, it's easy to understand why Leeson thought Japan's stock market would start to rise again. That said, the strategy was terribly dangerous, using high degrees of leverage, which grew as Leeson accumulated contracts and as these contracts lost money. In order to meet demands for margin calls, Leeson generated the cash he needed by selling straddles on the Nikkei. That is, he was selling matched calls and puts on the Nikkei index and using the income from these premiums to satisfy his margin requirements. Leeson's losses subsequently ballooned, but his control over both sides of the ledger let him falsify records to make it appear as though his trades were profitable. By the end of 1995, losses hidden in account 88888 exceeded £800 million, which was twice of Baring Bank's available capital. The end came with the earthquake that struck Japan in early 1995, which sent the Nikkei tumbling further. His futures bets had lost big, as had the straddles he sold, which only paid if the Nikkei index remained relatively constant. And Leeson fled Singapore. Investigators soon discovered the hidden account, and when the losses became public, Barings Bank collapsed overnight. It was sold to the Dutch conglomerate ING for the symbolic price of £1. Leeson served several years in prison, but the greater lesson wasn't about one man's deception, it was about the system that made it possible. Baring's internal audit reports had flagged the lack of segregation of duties for years, but management had ignored them because Leeson appeared to be producing strong profits. The same thing would be true in the case of Jerome Kerviel and SocGen. So let's fast forward about a decade to the case of Jerome Kerviel at Societe Generale, or SocGen, as I'll be referring to it. The biggest case of losses due to rogue trading to date. Kerviel joined SocGen in 2000 as a middle office clerk, later moving on to the Delta One trading desk, a low-risk arbitrage-based department handling index futures. Kerviel would use his deep familiarity with internal systems and controls from his time in the middle office, including his access codes to the system, to go rogue. Carvial was supposed to be engaging in low risk and low profit hedged trades, buying almost equal amounts of long and short positions on related European stock indexes. Because the gains of one position were offset by the necessary losses of the others, both upside and downside were limited. However, between 2005 and 2007, Carvial began taking massive, unauthorized positions on European equity index futures. Ostensibly, these were hedged trades, long and short positions offsetting each other. In reality, the hedges were fictitious. He used fake trades, forged emails, and system workarounds to conceal his true exposures. At its peak, Kerviel had amassed unhedged long positions totaling 50 billion euros, more than the entire market capitalization of the bank itself. But at least up to that point, things have been going okay for Cavial's trades, turning in almost $1 billion in paper gains by the end of 2007. All of this should have raised red flags all by itself. Recall that the desk Carvial was working was a low risk, low return desk, where profits were expected to be in the tens of millions annually. On this point, Carvial actually claimed in his trial that the bank management knew he was breaking the limits set for the desk, but deliberately had turned a blind eye so long as he was making huge profits. Whether that was true, the bank definitely knew shortly after that because things took a turn at the start of 2008 as global markets began to wobble amid the early stages of the global financial crisis. SocGen hurriedly tried to unwind his positions, but selling into a falling market led to it taking an almost 4.9 billion euro loss, the largest rogue trading loss in history. Carvial was later convicted of breach of trust and forgery, though many observers saw him as a scapegoat for broader institutional failures. After all, his trades had generated enormous profits in earlier periods, and his managers had rarely questioned how a mid-level trader could outperform entire desks. And they accepted at face value numerous excuses from Caraviel for why the risk management system had flagged this or that action the trader had taken. As with Nick Leeson, the culture of don't ask too many questions if the money's good prevailed. That is, until it didn't. Across both cases, and indeed across most rogue trading instances, we find the same systematic features. First, a lack of segregation of duties. Leeson ran both trading and settlement, while Caraviel had critical knowledge of both front, middle, and back office procedures and was able to manipulate internal records. Second, weak risk oversight. Middle office controls were understaffed, technologically inferior, or structurally subordinate to revenue producing desks. Third, there was an incentive for risk taking. When traders earned bonuses based on short term gains, the incentive to conceal short term losses is extremely powerful. Fourth, culture. Senior management in both firms dismissed internal audit warnings, believing their systems and people were too sophisticated to fail. The result was systemic moral hazard within the institution itself. As long as profits appeared, oversight slackened, and when losses emerged, they were ultimately catastrophic. Although Leeson and Caraviel are the most famous, they're far from alone. Rogue trading is a recurring feature of modern finance. For example, during the 1990s in Japan, Sumitomo Corporation's quote, Mr. Copper, lost 2.6 billion manipulating copper prices on the London Metal Exchange. His scheme lasted nearly a decade. Like Leeson, Hamanaka controlled both trading and record keeping, allowing him to conceal unauthorized positions. His losses rippled across the global commodities market and earned him an 8-year prison sentence. And in 2011, at UBS, a trader generated a loss of 2.3 billion through unauthorized trades in exchange traded funds. He exploited gaps between UBS's front and back office systems and falsified hedging transactions, much like Caraviel. As with Caraviel, early profits shielded him from scrutiny. When the trades went bad, UBS's reputation and share price took a major hit, leading to the resignation of its CEO. While attempting to attribute these episodes to, quote, a few bad apples, the persistence of rogue trading across decades and institutions suggests something deeper. In the end, rogue trading is less about technology or regulation than about human behavior under conditions of weak accountability. Nick Leeson wasn't a genius. He was an unsupervised manager given too much latitude. Jerome Caraviel wasn't a master criminal. He was a cog in a machine that rewarded risk. Their stories are cautionary tales, not just for finance, but for any organization where informational asymmetries and misplaced trust allow individuals to override systems designed to keep them honest. As long as profit and prestige are linked to short term results, and as long as oversight remains reactive rather than proactive, rogue trading will remain a recurring symptom of deeper structural flaws in modern finance. In the end, I'm inclined to agree with Duke Professor of Finance Connell Follenkamp, who says all rogue traders are the same. So the next time you read about a rogue trader wiping billions from the balance sheet of a major investment bank or other institution, don't be surprised if the story bears a striking similarity to the stories of Barings and SocGen.